Crude oil down now $1.30. Oil's pulled back all the way to 103. You know, we had gone up close to $109 a barrel in this run, and now we're pulling back. I had thought we might have gotten a little bit higher before the pullback, but a pullback is always expected when you get a big run. I think that this is just a pullback before moves to new highs.
What's happened with this price of oil? For the past month, the price of crude here in America, the West Texas Intermediate, is on a huge roll. But over the last week, it's gotten crushed, falling from 108 a barrel down to 103, putting a nasty buck-and-a-half bruising in today's session. The oil and oil service stocks, they've been real leaders in this market, but with the decline in crude, it's looking like these leaders, they could be taken in the back room and shot. That's why tonight we're going off the charts. Friday, got to figure this out. Got to figure out where oil's headed. You know where we're going to? A commodities expert. We're going to the help of Carly Garner. She's the co-founder of DeCarley's Trading and author of A Trader's First Book on Commodities, as well as being my colleague at realmoney.com, paid site of thestreet.com, who totally nailed the bottom in gold. Everyone thought gold was going much lower. She nailed it a month ago when we asked her help for a special edition of Off the Charts on June 28th. Given Garner's terrific track record lately, particularly with these commodities, how does the chartist who called the recent gold rally feel about the prospects for black gold, a.k.a. Texas Tea? First of all, take a look at this daily chart of West Texas Intermediate crude. As you can see, last month, the price of crude spiked dramatically. That's really unusual. Fueled in large part by the regime change in Egypt, the country that controls the Suez Canal, where tons of oil tankers need to pass through in order to keep the global oil market on an even keel. Then later in June, we got a surprise drop in crude inventories that added fuel to the fire. Next leg up. But Garner wonders if this huge spike higher was perhaps caused by traders who were getting too exuberant for their own good. The new caretaker regime in Egypt hasn't done anything to disrupt the Suez Canal. And as the turmoil in the Middle East recedes, the price of crude has a tendency to come back down. But the thing you really want to watch in the charts is at the very bottom here. That's the Commitment of Traders report, okay, COT, from the Commodity Futures Trading Commission, which details the size and direction of positions held by certain groups of traders, specifically large speculators, the big money guys, small speculators, and commercial hedgers who are messing around with oil futures because they actually need oil. Garner's used the Commitments of Traders report to very good effect in the past. It's what helped her nail the bottom of gold, so we've got to pay close attention. Right now, it is telling her that oil could go substantially lower. For 4 weeks, we saw the well-capitalized traders, the large speculator category, gobble up long positions on oil in the futures market, which led to a 16% increase in the price of crude. Okay, so here, the large, you can see they were buying, and that led to the increase, all right? Then last week, the price of oil began tumbling, and now Garner thinks there are a number of red flags here, which signal that we could be looking at an even bigger correction in the price of crude. Red flags like the fact that speculators have amassed a near record net long position in West Texas Intermediate, right here. Specifically, as of last week, large speculators were holding a net long position of 361,000 contracts. Just looking at this chart, whenever the large speculator at the bottom spikes, take a look. The price of crude tends to peak, okay? Look at this. I mean, isn't this gold? Look at that. Well, they peaked in the near term. Plus, Garner points out that the last time speculators were making such an impressive, aggressive, bullish bet on crude, the price of oil peaked near 115 a barrel in May of 2011 and then retreated to 95. That's a $20 decline in a few short weeks. And then in subsequent months, the price of crude plummeted even further. It went down to $75 a barrel. And now Garner thinks that in the absence of any renewed Middle East tension, we could see a similar vacuum in pricing. And I got to tell you, what that says to me, we have got, yes, another red flag. This worries me. If only because the only way for all these speculators who are long crude to exit the market is by selling, so at some point the enormous size of the bullish bet being made on oil could lead to a massive liquidation cycle, which Garner thinks could end in much lower prices. You can see the same thing happening in the option market. Check out this chart showing September 109 calls. I mean, it's really amazing when you take a look at it, okay? Look at this thing. Wow. Okay, these are options that give you the right to buy West Texas crude for $109 a barrel, all right? See, September 19. Okay. Now, and these expire in September. Looking at these options, Garner sees exuberant speculation going wrong. Looking back on July 19th, okay, let's go back in July, when the price of crude was near $108 a barrel, September 109 call options were trading at $2.30. I love the granularity of this chart. A big premium for what was almost an at-the-money option. That should have been almost flat. 5 trading days later, the price of crude was down 104, and this September 109 call had fallen through the floor. Look at this. It's now just for 50 cents. Now, you'd expect the price of call options to decline with the price of the underlying security, but Garner points out that what we see in this chart is a spectacular rise in price followed by a staggering fall. The option holders have already left the building, and Garner thinks that the large speculators in the futures market could be next, which could do enormous damage to the price of crude. All right, now I want you to take a gander at this longer-term weekly chart of West Texas Intermediate crude. Garner points out there is a long-term ceiling of resistance at around $110 a barrel, going back for more than 2 years. And this ceiling is held like a charm. This thing cannot get past this ceiling. She won't rule out a retest of the ceiling, but that does happen. I mean, it does happen. But Garner believes that if it does happen, it'll be short-lived, and the bears will ultimately triumph again in this thing. In other words, it can't get past that thing. Now, if you look at the relative strength index that's down here, the RSI, an important momentum indicator at the bottom, you can see that the price of crude is now entered extreme overbought territory. It's come up too far too fast. And as you can see from this chart, every other time the RSI has shown an overbought reading, the price of crude has rapidly declined. Look at this. Once again, overbought, then next there. Overbought, then next there. Okay, that's important. It is exactly what we're seeing now. It's very compelling evidence, isn't it? Garner also points out that this chart contains a distinct contracting triangle formation. We have resistance at 110 and an upward sloping floor of support of 96. She's saying that's a bearish pattern. And Garner believes crude could easily fall through that floor and be testing the next support level at 90. This is within the next few months, but it might even be the next few weeks. Last but not least, there are seasonal fluctuations in the oil market, and Garner notes that the price of crude tends to rally during the early summer months, but then by August, it tends to see significant selling as the summer driving season comes to a close. So the charts, they do not look good here, people. I think it's worth noting that some of the oil's recent rally has to do with the fact that West Texas Intermediate crude was artificially held down by a lack of pipeline capacity from the hub where it's priced in Oklahoma, Cushing. It was held down because they couldn't get to the ports of the Gulf Coast, which can be shipped therefore overseas and sold for a higher global price. I don't think those gains are going away. But on the other hand, West Texas crude closing the gap with the global price, I'm calling it a one-time move. Here's the bottom line. The charts, as interpreted by Carly Garner, suggest the future for the price of oil is Mr. T-like. It contains pain and more pain. If Garner's right, that will be bad for the oil complex, but it's good news for the vast majority of companies that actually consume oil and maybe for you at home. Hey, listen, she was dead right on gold. I bet she's going to be dead right again on this new, wildly trading commodity.